Thank you very much. So we're really excited to have this panel today, and I have to say, for everything that I've seen in this space over time, I have to say that I feel really privileged to be sharing the stage with such a wealth of experience and really kind of foresight to be investing in the space of crypto. It's no easy task to kind of take bets when you're not only managing your money, but managing other people's money. And the people that we have on stage today have done that in spades and done it successfully. So today's panel, I'm really happy to be able to introduce a lot of my friends here. David from Mindworks, Darren from Emergo, we've got Jason from Sora, we've got Peter from New Alchemy, and of course we've got Paul from Pantera. Before we start, I want to have them just go down the line and talk a little bit about themselves. Maybe who you are, where you're coming from, what kind of stuff you invest in, and then I'll ask one special question is, please tell me one recent public investment you made and why you made it. David.
Hi, everybody. Glad to be here today. I'm David Chang, managing partner of Mindworks Ventures. We are a traditional VC based in Hong Kong, and we love the crypto space. And recent deals we've done, Ethereum and also Hybrid Block.
Great.
Hi, I'm Darren Camus of Emergo. Emergo is a bit unique. We're the venture builder for the Cardano ecosystem. So we focus on building startup ecosystem and also have a venture capital wing that we're forming specifically for projects on Cardano.
Hi, Jason Fang from Star Ventures. I used to work for Fumbushi. I started the fund 6 months ago. We're a Cayman open-ended fund, 100% crypto. Most of our LPs are actually non-crypto people, so it's kind of like we're targeting a lot of the old money. Recent investment we did led the round for Myth.io, which is started by a famous celebrity entrepreneur in Taiwan, Jeffrey Huang. He's like the CEO of one of the top live streaming app, 17, and they're going public on the New York Stock Exchange.
Hey, I'm Peter Vesnes. Long history in crypto, from starting the Bitcoin Foundation on through to New Alchemy. New Alchemy started as a tokenization company, and then we've layered on 2 hedge funds and a kind of a venture growth fund. So we look at companies from seed stage all the way up to even post ICO.
Recent investment.
Recent investment. I like Heir Apparent, which is a hip-hop music platform that's kind of both a music studio and a Spotify killer. It's run by the manager of Kanye West label, Pusha T, and Summer Watson.
Cool.
Hi, my name is Paul Veratatakit of Pantera Capital. Pantera Capital has been investing into blockchain and cryptocurrency investments since 2012. And we manage about $1 billion. We do both venture capital and ICOs. I focus on both venture capital and ICOs in the early stage cycle. And in terms of recent investment, we invested into Codex, and basically it's using the blockchain to put high-valued, low-friction items, such as collectibles, on there for transparency and ownership, and using a token to sort of access that market.
Cool. Just to participate, my recent investment was in a company called Uppsala, which is around the cybersecurity space. So I want to start off, what I want you guys to get from this panel is really to understand a bit more about the crypto VC space, get a bit more insight into how we look at things, how we evaluate opportunities, and why we make some of the decisions and some of the decisions we don't make. And so I'm going to start off with a frame. And this frame is, since we're talking about the future of ICOs, our future VC, let's talk about the present and the recent past. Let's talk about exactly what does the past or the traditional style of venture capital equity investing look like. And David, I think you're probably the best person to start off with because you've really come from that and you're still in that space, right? So can you just set us a frame, like how should we be thinking about traditional style of VC investing?
Thank you, Gian. Like I said, coming from traditional space, we love the crypto space, but we are limited by the traditional VC's mandate and only allowing us to have exposure into equity. So to really bypass that, at Mindworks, we started a new vehicle called Blue Block Capital with a JV with a traditional VC, also called Gobi Partners, to tackle this. So we are trying to apply the institutionalized process of VC, such as FDD, financial DD, legal DD, and company DD, into ICO investments. So we at least have an investment process through IC meetings to deploy our capital into tokens.
Got it. And Paul, I mean, you also, I think when you first started at Pantera, you guys had your kind of exposure fund, your Bitcoin fund, but you're also doing a lot of equity investments as well, right?
Yeah, that's correct.
So can you just talk about how you were evaluating, again, the kind of traditional process for deals that you're doing investing in equity in terms of the investment process?
Yeah, I think it's pretty similar, and that's why I myself focus on both venture and ICOs, and a lot of venture funds are doing both venture and ICOs in terms of deal sourcing, finding deals from people that you really trust, and referrals from portfolio companies. I mean, that remains the same. And of course, trying to back strong teams. And strong teams means that, serial entrepreneurs, guys that have, already had experience in the space that they're now trying to tackle, or guys that have raised venture capital funding before and know what to do in terms of building a company the right way with the right governance. Some of the differences that emerge looking at token structures versus venture capital is the mechanics itself. I mean, looking at, for a token deal, does this token, is it really needed? What happens if we remove the token? Does that product or technology still function? And what really drives the value of that token over time? And how sort of strong and sustainable that is. And then, of course, looking at the deal itself, understanding lockups to understanding liquidity provisions to understanding even the different types of tokens. Is this really a security token? Is this a security token? And how does that affect things around regulations, et cetera?
Yeah, that makes a lot of sense. Peter, from your perspective, I mean, I also want to understand, when you're evaluating token investments in particular, right? Because you primarily invest in tokens, or you also do equity?
We almost only do tokens.
Great. So when you're actually evaluating token investments, what is it that you're looking for? Do you agree with a lot of what Paul is saying in terms of the factors, or what's the kind of key factors?
Yeah, obviously we look at teams, we look at the business model, we look at the token mechanics. I mean, there's some really interesting questions that aren't solved yet about how much of the value of these companies is going to reside in the token layer and how much on the cap table. And I think I'd be actually curious to hear what you guys think about this. I mean, some of our portfolio companies get in a situation where they use the token raise to force like a Series A at a high valuation. They basically can say, guys, I'm going to have $50 to $100 million unrestricted funds on my balance sheet in 8 weeks. So if you want in, now is the time. And I think all that I think is really interesting. And so we're kind of keeping an eye on that part of the process. Like, does that go nonlinear? Like, how rational is that? Anyway, so we think a lot about that kind of stuff.
And Jason, how do you think about the kind of token investments? What are the factors that that most make you say yes or no when it comes to token investments?
We're actually, so this is how I feel, right? So most of the ICO use cases you see now are essentially just use cases you see from blockchain equity investments 2 years ago. So realistically, we don't spend too much time on evaluating if it works or not. As long as these people, the team has the experience on building in that industry, we let them do it. What we do for most of our portfolio company is post-management and kind of community development. It's a token, right? So essentially, the more people you have on board, the stronger community, the stronger the price, and the higher the growth, right? So we partner with a lot of existing foundations. So we partner with Quantum Foundation, and Patrick Dai is our advisor. So we leverage a lot of their Korean community, their Asian community, exchange relationship with our portfolio company. We also we have our own token too. So we have a Sora Foundation, and we're able to indirectly work with a lot of crypto people, influencers. For example, we have Box Mining. He's a pretty big YouTuber in Asia, and we have a partnership with those guys too. And those guys are definitely way more experienced than in growth and Reddit and these community than anyone else in the VC space. And I think this is the value add for phase 1, phase 2. And then phase 3, which is the use case and partnership, that's where our traditional LPs come in. So our LPs are mostly third generation billionaires from Taiwan, Hong Kong, Macau. And those guys would usually come into our investments, co-invest with Sora Ventures, and so they'll have incentive to work with them.
Got it. Darren, how about you? What is the most kind of common, if you're anything, I mean, everybody here probably says no much more than they say yes when it comes to kind of being pitched for an investment. I mean, what's the kind of main factor for you when you say no to investment? What do you hope that the startup could have that they don't have that would make you say yes?
Well, I think we're looking at due diligence not so different from traditional VCs, which is team, traction, and use case and market. So A lot of people are raising on very, very lofty promises of products that they haven't built and a user that doesn't exist. So I forgot to mention our most recent investment is Traxia. Traxia.co. They're focusing on tokenizing invoice financing. And they're focusing on the fast-moving consumer goods between Europe and China. So it's a large market. It's a simple problem that can be solved. You can open up access to these investments through tokenization, and it's very simple. It's not just a promise, but they have traction. They have customers.
Hey, Jihan.
Go ahead.
I'm wondering, could we talk about how venture funds never trade their portfolio company stock, but token funds can all
Like
the time?
liquidity.
Yeah.
Yeah, sure. Let's do it.
I'm just curious to hear how you guys are approaching that. I mean, I was thinking like Codex did something really good where they gave early investors like a better price the longer they're willing to lock their tokens. I think that's what Mark told me. How are you guys approaching that? I mean, like, there's rules in the States, like there's a max number of trades a venture fund can even make, I think, per year.
Sure. Well, let's just kind of like make sure everybody understands what we're talking about here. When you're investing in tokens, like and in the pre-sale, which probably most of us are doing, and not in an ICO, there are deals which happen which specify, well, you might get such and such discount, and in exchange for that, potentially, you'll get such and such lockup, which means that you're locked into your position. And while people at the ICO can trade on date, as soon as it's listed, we're actually restricted. And obviously, the idea there is that you get to you get discount, but you give up liquidity. On the other hand, from a fund perspective, that liquidity is quite a big difference than the VC. So for you guys that are kind of understanding this side of it, I mean, it's important to get that. Now,
I mean, it's not even a venture-oriented token fund is really probably a hedge fund technically. Like it's anyway. So I think
well, let's start with you. So how about you? Do you trade?
We-
do you trade your positions or?
We definitely do. We're mostly buy and hold, so we're not like actively trading our portfolio company tokens. But we do take positions, yeah. And I think our portfolio companies, in general, probably don't talk to us enough about that. Like they're thinking. I mean, they think about the token value, but they also have their cap table, and so I'm not sure they track that as well as they should.
Paul, what about you? Do you guys trade or do you buy and hold only?
Yeah, I think for us, I mean, we're buy and hold. I'd say that, I'm not going to say that we never trade. I think there's a few different points where we do trade. I mean, if there's a token that goes up 1,000x, it's probably not prudent for that one position to be most of your entire portfolio, so you probably want to take some off the table. Or if you're fully invested out of the fund, if you want to invest into a new deal, then you probably have to take some off the table somewhere, right? Or, if a company, over time, I think this is actually something that I've heard from other venture capitalists. So in the United States, it's actually becoming very common for VCs to come into these pre-sales versus, I'm not sure about, outside of the United States if it's as common. But with VCs, they do want to buy and hold for a certain amount of time, but when a company pivots or hits an inflection point where they're not doing as well, and this is hopefully after maybe 2 or 3 years, then I think from what I've heard, they're going to really consider selling and actually acting more like a hedge fund.
I mean, that's sort of a dream for a VC guys. It's like teams melting down. They've got to pivot.
Yeah, to be able to have that liquidity.
You could hedge out at
Sure,
that point. Is
that
a
makes
big
sense.
difference.
But I mean, even us at Kinetic, I would love to say that I'm just, buy and hold until I die, right? Stick with the startup no matter what. But the reality of it is that I have a responsibility to the people whose money I'm managing, and that's really not visible to a lot of the startups. That we have a responsibility to them too. And if you're holding, if 80% of your portfolio is in one token because that token, went crazy, then, there actually is a responsibility to balance. But that's a hard conversation to have with the startup because there's a loyalty and there's a desire to be kind of stick with them. How do you deal with that? I mean, when you're having those conversations with startups?
Well, coming from a traditional fund, we have a limitation on exposure. Like we'll never have an 80% exposure in one position. So
What's a normal kind of exposure limit?
Maximum on a fund is about 10 to 15%.
But is that at cost or? I mean, like
At cost.
Okay,
At
yeah,
cost,
because then the flip.
And in a nutshell, we are long-term holders, whether it's equity or tokens. We would believe in the long game. So our fund life is 7 years. Even through our side vehicle blockchain, we expect at least 7 years as well of token investments. Yeah.
Jason, do you trade?
I think that's I think that really depends on the jurisdiction you're in. I guess most of us here represent the U.S. deals mostly, but we're Asia-based, so I see kind of like all deals around Asia, and more specifically, I'm more familiar with a lot of Chinese deals too. And Chinese deals are very, very different from the U.S. deals.
How so?
Whereas in the U.S. deal, I would just buy and hold. If it's like a 10%, 20% difference, then I wouldn't even invest because like my fund is 6-month lockup. So I would just try to do a long-term investment. In China, for example, I would do the opposite. I would try to get in the best deal, no vest, and then when it get listed, I'll just dump it. And that has been.
But actually, no, that's fair. I mean, there shouldn't be any judgment.
It's true.
But are you clear
if you
with
don't
your?
dump it, you become the. So if you don't dump it, someone else will dump it, right?
Right.
So
it's a defensive measure, even.
exactly.
But how about the startups? What do you say to the startups, or how do they feel about that?
They feel great. You know? No. They feel great because if you think about it, you're making money for your investors, right? So like, I'll definitely bet on you again, right? So and then after that, then they'll be in this hibernation mode for a long time where they have to get this new market, this new community. But it's a different strategy. It's a different play. It's a different market. That's how Chinese investors, do it, and that's why they're super, super liquid.
I think I want to be an LP, but I'm not 100% sure. I think I do.
Darren, how are you thinking about this?
Yeah, I mean, these are the moral qualms you get. You have an immediately liquid secondary market that's mostly liquid, relatively liquid. And you have new moral and potentially legal qualms. I'm very much into self-regulation by the industry, also because it's tokenized and it's on a blockchain, it's completely transparent. So, for example, I mean, everyone here has built some reputation. And if you are the person that's going out and dumping your tokens to make a quick flip, everyone will take your money for a certain time.
Except in China.
Exactly.
Well, they'll take it every time.
I think it's important to highlight, for those of you who are starting ICOs, the relationship with these token buyers, in some ways, the funds have a lot more power than a traditional venture investor would have. Like we often hold many days worth of average daily trading volume of these tokens, and could really set the price. And so I've seen some of my clients and/or portfolio companies get into a situation with like a kind of a whale that took a lot of an early round, and it's they're not happy. Like you have to work with them in a way that, as a younger entrepreneur, you might not be used to. VC's unhappy. Okay, what are they going to do? You're going to work it out. Yeah, so I think that's different.
Yeah, I definitely think there's a lot of dynamics in the crypto space which you just wouldn't necessarily see in the VC. I mean, at least in the past 2 or 3 months, I've had multiple deals where the startup came back to us and said, we've been offered, the entire round by a Chinese investor to take the entire $30-40 million round, and I'm always telling them that's crazy. I mean, if you take that deal, you're basically working for them, and you have to really have a lot of trust. But is it something that you've seen before? Or?
Well, listen, I think as a community to mature, and as ICO investors are getting more and more sophisticated, processes will be in place. Similar to IPO market, I think there needs to be a lockup for institutional or pre-sale investors, plus green shoes and market-making capacity to stabilize price. This must be done for us as a community to grow. And eventually this will happen. That's why in the IPO market, there are book runners, there are banks stabilizing these prices. Yes.
What are the other mechanisms that you guys can identify that will help to smooth out this market? Or do you think that it will ever be smoothed out? Or do you think it's just going to stay this kind of wild where it's a bit, it does feel a little bit like the Wild West. We're making up the rules as we go along. Yeah. Is it about liquidity? Is it about regulation? Is it about kind of concentration of jurisdictions? Where do you think we start to kind of, balance? Anybody?
I liked Aeon. Aeon had a good method where it was a voluntary lockup. So post ICO, everybody had their tokens. And as it happened, they raised enough money kind of in their very first round to launch their project. So they had a huge amount of tokens left over, like 50, 60%. And they basically said, we're going to put those tokens in a smart contract. Everybody who locks their tokens in will share pro rata all these spare ones. And the lock for founders was 3 years, but voluntary for founders, and 1 year for non-founders. I thought that was cool because you could kind of people could pick their poison. They could keep some liquidity if they wanted, and they got hugely rewarded. As it happened, most people locked, like 90% locked, and that made sense. I think there's probably a lot of room for innovation still out there in this space.
How about the regulatory side, or whatever? What do you think would help smooth it out?
Yeah, I agree. I mean, I think whether it's similar to the IPO market where there's a lockup at the end, I think in Silicon Valley we're seeing a lot of equity deals that also you get tokens on top of. And I think we'll also see multiple rounds. So I think that gives entrepreneurs more discipline. There's going to be milestones that they have to hit before raising their next round. And I think that's very different than what we're seeing in Asia, where it's like $30 to $50 million right away. So there are structures around governance. There's structures around milestones, and I think even though we're not going to wait 7 to 10 years before an ICO, it's going to be definitely accelerated. But I think that will at least give a better relationship between investors and also the entrepreneurs.
Well, I think there's even more hurdles to jump through. Like some of our companies are tokenizing, and even our accountants don't have procedures to book these tokens. They don't know which line item on the balance sheet to be booked on.
Yeah. Yeah, there's a lot of financial infrastructure to build for traditional money. Yeah.
Let's look forward for a second. If you were talking to one of your potential, or one of your portfolio companies or a potential portfolio company that you want to invest in, what is it that you tell them in terms of kind of sale design or structure? What is a kind of ideal scenario for you as an investor, which you think would give them the most kind of fundraising potential, but at the same time, probability to succeed as a project and as founders? How do you kind of design that? What are the factors to success, you think?
Maybe an update. Recently we did an equity deal, and we actually added a few line items to the term sheets and shareholders agreement stating that any future token issuance will be prorated, given back to equity shareholders. So this is one way to, to share the economics.
Got it. Darren?
I think it's flexible. The problem with, one of the big problems I see with the space is there's perverse mechanisms. So entrepreneurs can raise, they can get all their money up front, they can not lock their tokens, and they have immediate access to a huge pool of liquidity, both in their tokens and in the raise. And they don't have an incentive to do necessarily anything. So I like the idea of controlling your first raise. Actually, what do you really need to build your product? And maybe holding some of that capital back because it might work out better for the team in the long run.
Got it. Jason?
I think that really depends on every project. I think every project, it just depends, because some project would, they would have a really large community already, and some just require a lot of community, and for that reason, their structure to be more open. They're willing to give up more token. Whereas some is, if the businesses are more kind of like business orientated, then realistically they don't need that many people. Their model will be slightly more centralized. And I think the most important part is when you do any form of token structuring, you got to understand that this is going to be a long-term thing. So you can't like give out all tokens from day one. You definitely have to do it slowly, and you have to look, you plan it maybe like 1 year, 2 year ahead of time.
Peter?
Yeah, we're seeing, I guess we're seeing some trends. So it's turning into venture rounds for like how we see it. So there's tends to be seed round, which is like largely around a little bit of tech proof, getting out in the marketing, community marketing side. And then I think the good entrepreneurs are like trying to get hotly contested A rounds where they can kind of vet out who they want for their big pre-round before an ICO. One thing compared to a year ago, as you guys know too, a year and a half ago, the thinking was that the public capital, the ICO part, would provide most of the money. I think nowadays it's mostly that's happening earlier, and the public part is to create some market liquidity. So that's a difference.
Great. Paul?
Yeah, I think the way that I would think about it would be on the flip side. I mean, who do you want as your investors? What type of, and again, like Jason mentioned, case-by-case basis, if you are maybe an infrastructure platform layer protocol, then you just want to maybe just raise from anybody, credit investors. But if you are an enterprise company, you may want to raise some VCs because they have a lot of relationships already. So VCs tend to like equity rounds, so equity plus maybe some sort of token bonus on top of it. And then I think the second thing is, how is the market doing right now? I think it's better to raise less and perform and have more operational capital by actually providing higher token value. So that's going to be dependent on how the market is.
Got it.
All right. That is one thing some entrepreneurs are missing up front is like, you want to have enough demand that a market's created after the tokenization. You don't want to suck it all into the tokenization.
Got it. We're out of time, but one last word from everybody, if you feel so inclined. What is it that you wish for, the startups out there who are either kind of constructing themselves or planning their sales, what is it that you wish for them to know or to kind of take on board? For me, it would be play the long game. Most ICO or most startups don't succeed, so that means that a lot of this process is a relationship game. Build good relationships over time so that even if this doesn't work out, you can restart, you can have those relationships to persist.
I think it's have a close to or working product before you approach investors and to showcase something before you just instead of just pure idea stage.
Great.
When you're raising, that a token sale is actually part of a user acquisition strategy, and your investors may actually be using the token. It's a great way to build an ecosystem, and you have incentivized participants. So be very smart about where you're targeting your pre-sale.
Jason?
Yeah, in general, I think you just got to really pick the right investors, and you got to understand their incentive and kind of like their motivation to work with you.
I'd kind of go different. I think the reason we're all here fundamentally is that Bitcoin was successful at keeping things decentralized. So I think don't let money get in your eyes, but remember this just turns into traditional finance if you're not working to create a decentralized infrastructure platforms.
Yeah, I would say take your time. I think in the past people have just rushed out there just to try to beat the market, accelerate with the market, and take your time in terms of product. Take your time in terms of learning from other entrepreneurs that have done it before and educate yourself. And take your time and build a great set of advisors so that you can have the right mentors, especially as you go through different hurdles.
Great. Thank you very much for your time. Thanks to all the awesome panelists. Great discussion.